Hello, Uncle Jim here. Do you want to be able to retire early? Well, I've been on a journey for the last 2 years to learn the right way to sell options. It's been a great way for me to earn quite a bit of passive income. Today, I want to share with you how that has lent itself nicely to being able to retire early. I'm going to share with you some trades and a spreadsheet that I use that kind of gives me the feeling or the understanding that I can retire now if I wanted to. So stay tuned. I think you're really going to enjoy what I have for you today. Okay, let's go ahead and jump right in. First off, I do want to give a quick update, at least my typical update I like to give related to the market. It's been kind of a topsy-turvy week. One day it's up, next day it's down. I think we're going to see that for a while. I do think the Fed will probably raise rates again, probably, I believe maybe in March. That may be their next meeting. And then I do think they're going to be done at some point, maybe like I've said in previous videos, maybe by summertime or early fall. And then they're probably going to hold steady for quite a while. Maybe for the next 6 months, they're going to keep rates fairly high. I don't think they're going to start lowering them till very late this year, maybe early next year. And that's going to help the, inflation come down. And, so I think the market's going to kind of be topsy-turvy for the rest of the year. I do still believe we're going to end the year higher than when we began. I think we're going to be probably 8 to 10% higher than the beginning of the year, or when we started 2023. I don't think we're going to see new highs or be in a true bull market. Maybe in 2024 we will. But at least that's my 2 cents. That's what I'm thinking. But I do think it's going to still be a great time to actually sell options and do quite well selling options. So that being said, let's jump into the main focus of the video, which is related to retiring early. And, part of why I did this is I want to be financially independent. I want to have the ability to retire when I want to. I don't know that I'm ever going to completely retire. I'm always going to be doing some work on the side and, like doing these videos, as well as I still do software programming and some development. And I think that's just going to continue. But what's allowed me to do that is selling these options. And what's been critical for me is being able to pick really good companies to sell the options with, picking companies that are growing their dividends, have some growth, healthy, valuable companies that are making, good money. I'm not a big risk taker. I like slow and steady. I like good dividends. If I would, I'd probably just literally live off my dividends because in my mind, they are the most passive type of income. And then with selling options on these companies, I'm actually able to generate quite a bit of cash. And since it's companies I really want to own, I don't really worry as much about if they're assigned to me. It works out quite well if they're assigned to me because, again, these are companies that I want to own. And what really makes a huge difference is the combination of the premiums that I'm earning from selling options, the dividends, and then also working some on the side. Like I said, I do software development, so I've got a couple clients that I'm still doing work for, but it's more on a part-time basis, more like 10 to 15 hours a week is all I'm working currently. And I'm able to live off that. I'm actually able to live off the dividends and the premiums from selling options and don't even really need the extra work, but I do like, I do like working. I do feel like it keeps me busy, keeps me kind of having to think pretty. Software development isn't easy, and it's something that kind of keeps me on my toes and makes me have to continually think deeper and harder about certain things, especially with some of the development work I'm currently doing. Now, another part that I like to share is I'm also an advocate of the 4% rule. There are a lot of people, financial people, who don't really like this rule, but I think it's a great guideline to use, and it's just simply that you can live off of 4%, spending 4% of your portfolio in any one year, and if you keep it to the 4% or below, your portfolio will probably outlive you. I think it's like 80-90% chance that it'll last 30 years, and I'm 57, so I mean, I doubt I'll live another 30 years. My guess is I'll be lucky to live into my mid 80s or low 80s, or younger 80s. I don't know how you quite say that. But selling options, as long, with dividends, really works out well with this 4% rule. You almost don't even need to use the 4% rule. But for me, it's kind of like a backup plan. The 4%, or in my case, I actually use the 3% rule, at least in my planning for retirement, instead of the 4% rule. And I believe with the 3%, using that instead of 4%, it doesn't just last, it increases substantially, and I'll end up leaving a lot more to my son. So, and then one piece that's been really important for me that's helped me with selling options, especially for retirement, is sticking to safe strategies, limiting the risk. And I've talked about that in a lot of videos that's related to when I sell puts, sticking to deltas. And delta, for those of you who don't have never heard that before, it's what's called a Greek. And the simplest way to think about it, let me just give an example. A 20 delta is almost like a 20% chance that that contract's going to be assigned or executed. So a 20 delta is like a 20% chance that it's going to be executed, or an 80% chance that it won't be executed, and you just keep the fees that you picked up or the premiums you picked up. So I do a 20 delta on my calls and what's called a 15 delta on my puts. So, you never hit exactly 20 or exactly 15. It's usually 22, 23, and 17, 18, 14, sometimes 16 deltas for my puts. But sticking to a lower delta for puts has worked out well during a bear market. Now, in a bull market, it may change. I may do a little bit more risk in the puts, meaning I may go to a higher delta and a lower delta for the calls, mainly because with the stock market going up, it might be better to take a little bit less risk. And typically, when you have less risk with a call, you're wanting to sell it at a higher price, and the same thing works out with puts. If you're taking less risk with a put, you're wanting to buy those stocks at a lower price. So just kind of, that's one of my main ways to mitigate the risk. It's also, I will go farther out. I try to pick up a certain amount of premium. So I've had people ask me questions, why do you go out 2 to 3 months? In some cases, as far as 6 months. And it's all related to picking up the premium that I want to pick up. I try to pick up $100 per contract, and sometimes that requires me to go a little farther out. Now, recently I've noticed this premium's been a little bit down on the put side, and so I've gotten a little bit farther out. But what's worked out is when these stocks have gone up, I've noticed that I've gone into the profit or become profitable with those trades very quickly, and I've been able to close quite a few of the trades. And that's one of the goals this year compared to last year. I'm trying to close a lot more of my trades, especially when they become profitable at around a 75%. And that's also given me a lot more opportunities to make more trades and do a little bit better. So, and then I don't take a lot of risk. I typically don't do many contracts. For any stock that I might sell, I typically don't do more than 2 contracts, unless it's a really expensive stock like not Apple. Apple's expensive, but Ford, or some of the others that are less than $15 on. And I do sell stocks like Apple, or puts and calls on stocks like Apple, but it's a lot more expensive. I think it's right around 150, and I'd actually like Apple more at like around 130. But I only typically do 1 or 2 contracts with those. So I've seen people out there do 40, 50 contracts at one time on one particular stock, and I try to stay away from that. I prefer to keep it very risk averse. To me, it's augmenting my income. It's not replacing my income, because I like what I do. So it's just that it gives me an avenue to be financially independent and pick those kind of software jobs that I want to work on versus the ones I don't want to work on. And then the last point I wanted to make is I've had a lot of comments and discussions with people, and I do feel like a lot of people out there will do a lot of fear and overthinking related to both selling puts and selling calls. Sometimes, they're too fearful to actually make the trade, or they make the trade and get out of it too quickly. What's really important with selling options is patience. A trade, it may not be there one day, but it may be there the next day. And also, some days are much better days at trading. So if you're not finding anything in the market on a particular day, wait till another day, or even another week, depending on what's going on. And then, typically you want to be selling calls on up days and selling puts on down days. So there's some basic ideas. If the market's way down, you don't want to really be looking at selling calls, or if the market's way up, you really don't want to be looking at puts. So, and then trying to keep things simple. I see too many cases where people are really making things really, really complex. To me, I pick stocks that I want to own. I know values or strike prices I want to own them at, and I know typically, when I want to own them and how much I can own. And, the ability of selling options and growing your cash along with making the trades has lends itself really well to adding more and more to your portfolio. So now next, let's jump into this next part of the worksheet. I did 5 trades this week. I've done over $1,000 again. Last week I did over 1,100. This week, and I still got the rest of today. Of course, I think the market's closing here any minute. But I have tomorrow to trade too, so I probably will do one more trade, and so again we'll be close to $1,100, $1,200 for this week. And they average again about $200, about 100 per contract, and I believe the yearly return for them averaged out right at 30%, but we'll see that in the worksheet at the very end of this video, or the next part of this video. And I also wanted to share another spreadsheet I have, which will be literally at the very end of the video, that I share with you how I kind of do my calculations and figure out, am I ready to retire? How do you really know? So many pundits out there try to scare people so much, make you believe that you don't have enough and you'll never have enough, or you need some outrageous amount of money. So in the very final part of the video, I'm going to share with you, my thoughts on that, and the spreadsheet I actually use that has my budget as well as how I tie in the 4% rule. So stay with me to the end of the video. And as always, please subscribe, hit that like button. Take a look at my memberships. I try to post something every day. I'm going to share any of the worksheets that are in this video to my memberships, as well as I have some things I'm looking at doing. I do have one portfolio that lends itself really well to sharing with my patrons, and I'm going to start doing that in March. So stay with me. I've got more to share, and let's jump into the next part of the video. Okay, here is my planning worksheet that I distributed on Monday to my memberships. And at the top of this spreadsheet, I do have my favorites, or what I recommended at the beginning of the week. I'm not going to go into a lot of details on these favorites, but I listed IBM, and I typically put the current price, what strike, expiration. If it's a vertical put credit spread, I also put the outer strike, and I put delta and total premium, and that's kind of like an estimated premium. So my favorites this week were IBM, SCHD. All of these I've traded in the past, and actually I believe I hold positions in all of these currently. So for both IBM and SCHD is a great growth dividend ETF. If you don't have it, it's something you should seriously consider to look at. GLW, that's Corning, another great company, and I believe I actually have done a trade in this week that we'll talk about down below. BP, again, is another company that I've done a lot of trades with, and I do own a couple hundred shares of it, as well as I still have some contracts with them. So I had listed those were my primary favorites for this week. The green are the ones, the trades that I actually did this week. The others are still out there. This HEEDG is a Wisdom Tree European ETF, and it's in the money at 75. I'll probably roll it next week. I haven't been able to find a whole lot of good premium with it, but I'm also okay with it being assigned away from me. It's one I didn't really want to own, and I've been able to continually roll and earn more premium on it. So, but at this point, it is $2 or $3 in the money, and again, I'd be perfectly happy with it being signed away. I would put those funds towards something else I'm more interested in. So, and then here's the actual trades that I did this week. I rolled Corning GLW, and I rolled it. I kept the same strike prices mainly because I like that price for Corning. $35 I think is a very reasonable price for them, and I rolled it out to 519. It was expiring next week, a week from tomorrow, and I picked up $176.80. I believe, again, I don't worry about the delta so much with rolling. If I'm happy with the price on the stock or the strike price, then I typically will keep it, or I will try to go a little bit lower if I can. But I really like Corning. I wouldn't mind owning some more, and that's the required cash or margin that was needed, and it's a 35% yearly return, so not bad. My next trade was TFC, which is Truist. This is my bank that I use. I've been really happy with them. It merged SunTrust and BB&T merged, and I believe earlier this year or late last year they finished the merger. So they're going to have some. I think they're going to have even more income coming in since they don't have as many people working on the merger. And I rolled Truist. It's a cash secured put at 45. It's currently at 49, so it's outside the money. And it was expiring on March 17th. I moved it to, or rolled it to 616. I kept the same strike again because I'm perfectly happy with the 45. I don't know that it'll even get back down to 45. They pay a good dividend, and so I wasn't. I think even at 45, it's still a fairly good delta. I think it's around a 20, 22 delta or something like that, which is a little higher than what I typically like. But in this case, I'm happy with owning Truist. But like I said, I doubt it will get back in the money. But if it does, I'm perfectly fine with it being assigned to me. I made $183 on this roll. And what's interesting, again, it wasn't going to expire till March, and I still picked up quite a bit of premium. Since it's a cash secure put, there's a little bit more of how I calculate cash or margin that's required, and it was more like an 8% return. Basing it on the fact that looking at June 16th. So, but again, to me, it's just an extra way to generate some cash. Next, I had this is Williams Sonoma, another great company, no debt, well managed. They also pay a good dividend. I think they're increasing their dividend faster than any company out there. I'd have to look again, but I believe it's over 15% on a yearly basis. But really good company. It is a little bit more expensive, but I did 110 short strike, 100 for the outer put that I purchased, and it was an 18 delta, 18.52 delta, or just shy of a 19 delta. The current price is 132, so I'm pretty far outside the money, 110. I don't know that it'll get down that low. And I still picked up $325, so it worked out quite well. This is my best trade. And then the required cash and margin, 1674, and it was 70% return. Again, another great company. This is probably the fourth or fifth put that I've sold on Williams Sonoma. So if you don't have it as one of the stocks on your watch list, it's something I would definitely consider including. Next is CWH, which is Camping World, and I've been working with Camping World since the beginning of 2022. I believe this is the fifth or sixth trade that I've done with them. Mostly they typically expire. So this time it was 22 was the short strike. I did an 18 delta. It's currently 25, and again, this was a roll, so I rolled it out to June 16th. and again kept it at the same strike price of 22, which again with it currently being 25, if I could get it at 22 I'd be really happy. At 22 I believe it's close to a 10% dividend, which is unbelievable. And again, for as little cash as needed, I brought in close to $180. This was for two contracts, so and the fact that it was a cash secured put, the required cash that I need or margin that I need is a bit higher, and the yearly return because of that was closer to 15%, which again is a really good return. And then finally, this BMY, I did this trade earlier today. It's a vertical put credit spread with a 65.55 and an 18.48 delta, so very close to the same delta that I did on Williams Sonoma, and expiring on June 16th, just like one of the other rolls that I did. The current price is 72.37, so it's also pretty far outside the money, and I was able to pick up $161, and the cash outlay slash margin was 1838, and this is like a 25% return, yearly return. All these are yearly returns. So if I average these, I averaged $205 for each trade. Again, that's what I'm shooting for, $100 per contract, and each one of these had two contracts. And for on a yearly return, it's like a 30% return. So these are all good companies. This has worked out well for me. So those are the trades I've done this week. I probably, like I said, will do another trade probably tomorrow. I found I've spent maybe 30 minutes each day doing a trade, maybe not even 30 minutes. If I wasn't sharing these trades with my memberships, I probably could have done it in half the time. So that's this part of the video. This is the trades that I actually did this week. Now let's jump into the final part of the video. I'll share with you my worksheet that I like to use for budgeting, as well as tying in the 4% rule. So stay tuned. Let's jump into the next part of the video. Okay, so here's my budget 4% rule spreadsheet, which is kind of a weird name, but in a minute here you'll understand why. So I actually use this. These are actual numbers that related to my budget. These are amounts that I keep up to date, and this is what I spend on a monthly basis, which is just a little bit over $4,000. So here I've got just all my household expenses. Some of these are in red mainly because I need to keep track of them. They may change. And then on the right side, I've got just some basic brokerage accounts that I'm listing here, which helps with the 4% rule. And then at the top, I do have a link to my favorite 4% rule calculator that's out there on the internet. So you can use this and luckily it's fairly easy to find. It's literally the 4percentrule.com. And so a lot of what I'm talking about is based on what I found using that website and figuring out what I need on a monthly basis. And then I also included here dividends based on, again, my brokerage account and retirement totals. Now, these aren't my actual numbers, but I wanted to show that, you could potentially retire with $500,000 and do quite well. I actually think you could retire for even less than that, but I just kind of wanted to use this as a slightly different guidepost. So here, this is just 3% of these accounts. Options premium, this is literally $2,500 a month. So again, I can do better. I've been able to do, especially in one of my accounts, I've been able to do 1.5 to 2.5% on a monthly basis. I talked about that in my last video, but this is using like a 0.5% in order to come up with this amount. So it's literally kind of thinking about, most people with selling options, once you've figured out what you're doing, should be able to do a 0.5% on a monthly basis of that account. So if it's $100,000 account, you should be able to do 500 on a monthly basis, and that's kind of where I'm coming up with that. And that's what I was able to do almost from day one when I first started selling options. So that's why I have the 30,000 here in options premium. Now I put 12,000 in work. Again, I'm still working. I'm working part time. Um, Still doing software development, just supporting a couple clients. And I think that's a great way to do it. I don't know that I'll ever completely retire. I like working, it keeps my mind sharp. But I do have lots of other things I like to do. I play tennis, I play golf, involved in a men's Bible study, and so on and so on. So I like to stay busy and I like to have other hobbies. But again, I also still like to work. Then here's the 3% rule again based on these numbers. Um, and then, so I did it, I broke it down by two different things. So the first part is based on the brokerage account, and the second part is based on my retirement accounts, keeping in mind that, once I'm 59 and a half, and I'm currently 57, so you're really only talking 2 years that I would start using or drawing down some of these funds. And then on a yearly income basis with the 3% rule, I'd be bringing in 57,000, which is pretty close to what I'm bringing in now. So this is fairly accurate, um, which is 4750 on a monthly basis. I spend about 4200 monthly, and I have an extra 550 on a monthly basis. Now, typically I'm bringing in a bit more income than that. I'm probably like the 12,000 for part-time work is probably more like 22,000 or something along those lines. So this is from my own picture. It's still not the same, but again, my emphasis was on someone who has a $500,000 portfolio. And then here I've got retirement at 59 and a half. I'm summing all these values once I reach 59 and a half, and that's before taking Social Security. I'd be bringing in 72,000 a year, which is 6,000 a month. And then I based my expenses, I increased them on an inflation basis, and still I have enough, and I'm bringing in enough. And then at retirement, full retirement age, I'm thinking I probably wouldn't take it till I'm 67, or maybe even, I think, what is it, 70 or 71? You can take it at the latest or the oldest point. But I was thinking more like 67. I'd be bringing in 8,200. So the big difference here is the 2216 is what the Social Security, how much I would get based on full retirement age, um, which again would be plenty of money to live off of, even with inflation of 3%. Now, 3% is probably too low, especially I believe we're at 5 or 6% now. We were as high as 9, but I do think by the end of the year, and especially if they change some of the or fix some of the supply chain issues and some of the issues related to drilling on our own lands and freeing up some of our natural resources, I do think we'll get back to closer to a 3%. But I have plenty of cash here that even a 4 or 5% I should be okay. So, and this is what I use, and I set this up and I track it and keep track of any of my expenses that need to be increased. But this has worked out quite well for me, tied in with the 4% rule. So, as always, if you're curious or have any specific questions, please add a comment below. You'll probably notice with my channel, I try to answer all the questions. I pretty much have answered all of the questions. I've had one or two where I've missed one, but it's pretty rare. So, if you have any questions, just leave them below. As always, I love communicating with people and sharing my thoughts, especially if they have questions on what I'm doing or why I'm doing something, or even if they find a mistake in my video. I don't really get my feelings hurt. So that's it. I hope you enjoyed this. I hope you're having a wonderful week, and thanks for joining me. Have a great day. Bye bye.